If you own a home, townhome, or condo in Greater Vancouver right now, or you're thinking about buying one, this video is for you. Because something is happening in the market that most people are not even paying attention to, and that thing is interest rates. Not the rates that dropped over the last year. I'm talking about the rates that are starting to creep back up because of one major factor. If you remember what 2022 felt like, you'll want to stick around for this one. Now, let me give you a quick recap of how we got here. After COVID, inflation absolutely took off. Supply chains were broken. Sometimes buying a new vehicle or even household appliances took months or even a year. Now, the government then printed a lot of money and consumer demand spiked. At its peak, inflation in Canada hit 8%. And to bring things back under control, the Bank of Canada started aggressively raising interest rates. When borrowing gets expensive, people start to spend less. And in real estate, this changed the market almost immediately. It was out the industry. Mortgage payments got more expensive, buyers qualified for less, investors started pulling out of the market. In fact, most investors have completely left the market, some putting their money in other countries. And the Greater Vancouver market essentially froze. Because of this, prices started to fall. And what we went through was one of the sharpest corrections that we have seen in decades. So here's where things get interesting. After all of that, the Bank of Canada spent the last year or so cutting rates, trying to stimulate the economy. And buyers started to feel cautiously optimistic again. But now, those same economic forces that triggered the 2022 downturn are starting to show up again. And this time, it's driven by oil prices. Because of the ongoing conflict in Iran, oil prices have risen by more than 50%. Just look at the price of gas next time you're driving by the gas station, or I'm sure you've already feeling the pain unless you drive an electric vehicle. Now, you might be thinking, what does oil have to do with Vancouver real estate? And the answer is a lot. And that's because when oil prices go up, everything gets more expensive. Gas at the pump, transporting goods across the country sends a ripple effect through the supply chain, including raising the cost of food prices at the grocery store. And all of that is inflation. And that's exactly what the Bank of Canada is scared about right now as we speak at the end of March 2026. Now, this is the part that I really want you to understand because a lot of homeowners and buyers think interest rates are controlled by one thing, but they're not. They're actually controlled by two separate factors, and that affects the rate that you pay as a consumer. Force number one, let's talk about variable rates. These are the rates that are set by the Bank of Canada. Every 6 weeks or so, they sit down and set what's called an overnight lending rate. Banks borrow money from the government at that rate, then they add a small premium on top and they loan it out to you. So, when the Bank of Canada raises rates, your variable rate goes up with it or down with it. So when the Bank of Canada raises rates, your variable rate goes up with it. And when they cut rates, it goes down. Right now, the overnight rate sits at 2.25%. But some economists are already starting to predict that the Bank of Canada will raise rates again this year. Some are calling for up to 3 rate hikes before the end of 2026. And if we're looking at the start of the year, there wasn't that prediction at all. Now, force number two, that's fixed rates. This one is different and it matters more for most buyers because most people prefer a fixed rate. You lock in a rate, it doesn't move for 3 to 5 years depending on your term. You get stability. I think this is a great option for most people. But here's the thing, fixed rates in Canada are not set by the Bank of Canada. They're driven by something called bond yields. A bond is basically a loan to the Canadian government. The government pays you interest in return. When those bond yields go up, banks have a choice. Do we buy these bonds and earn 4% guaranteed from the government? Or do we lend this money out as mortgages, which obviously carries more risk, but should earn us more in return? The answer is clear. If bonds are paying 4%, the bank needs to charge you at least 5% on a mortgage to make it worth their while. And right now, bond yields are already going up. I'm talking to mortgage brokers about this every single day. Fixed mortgage rates have already started to rise. And the prediction is that they're likely to rise even more as oil and gas prices continue to push inflation higher. So here's the big question that everybody's asking. Are we headed into another 2022 and going to expect, 7 rate increases in a row? I hope not, but unfortunately, the forces are pretty similar right now. But let's talk about what's different because it's not a clean comparison. So let's talk about the positive. What's better this time? Back in 2022, inflation hit 8%, and now is an absolutely triggering alarm. Right now, inflation is only sitting at around 1.8%. So even if oil prices stay elevated and inflation climbs to around 3%, that's bad, but it's not 8% like it was. Now, on the other side, what's worse this time? In 2022, the market was coming off record highs. Prices were elevated. There was room to fall. Right now, the market has already dropped significantly. So if mortgage rates continue to rise in an already weak environment where the market's fragile, the downside hits completely different. We're not correcting from a peak anymore or potentially pushing down an already weak market. We're dealing with historic high inventory levels. Developers are struggling. Some are going bankrupt. Projects are being canceled. More inventory, more pressure on developers, more buyers sitting on the sidelines. And that's what's so concerning to me. Now, what do you actually do with this information? If your mortgage is coming up for renewal in the next 6 to 12 months, pay close attention to fixed rates right now. Don't assume that they're going to stay exactly where they are. Please talk to your mortgage broker sooner than later. There's options to start a new mortgage sooner than the end of your term. Lock in while rates are still relatively reasonable if that's the right call for your situation. Now, if you're thinking about buying, I'm not here to tell you to panic because I'm here to tell you to be realistic about where rates could go. Run your numbers at a slightly higher rate with your broker than what you would actually qualify for today. Make sure you have a buffer because if interest rates do move, the last thing you want to be is stretched to your limit with no room to breathe and basically be house poor. If you're an investor, not many people are investing, but the math is tighter than ever right now. There's higher carrying costs, softer rents across basically every single segment, and more supply coming on all the time. So make sure you're stress testing every deal before you commit. Now, here's what I know for sure. Nobody has a crystal ball. Not me, not the economists, nobody. But understanding what's actually driving these forces and knowing the difference between the two rate mechanisms puts you in a better position than most people. Because most people just hear rates are going up or down and they react emotionally and quickly. So now you understand why, and that matters. I'll keep covering this as it develops. If you're not subscribed yet, now is a great time. I'm putting out regular market updates specifically for Greater Vancouver, and things are moving faster than ever right now. The market continues to change. Unfortunately, prices continue to come down. If you're here in the Lower Mainland, if you want to talk through what this means for your specific situation, my contact info is always below. No pressure, just a conversation. You can book a call with me. Even if you're anywhere in North America, I have a massive network of agents that I can set you up with. Thank you so much for watching. I appreciate it. I'll see you on the next one.